Welcome to the What to Watch video update. Every week, I do a number of different videos. I do a video every day. I do a weekly video. Also, once a week, I do two other videos called the Intermarket Analysis video. And then I do another video called the Deep Dive video. Sometimes we have charts that are not really saying anything loudly right now. And I put those into the deep dive video because we have to dive deeper to see if we're getting any clues from those charts. Then the final video that I do that has developed into a weekly video, but I can also redo this video on an as needed basis if things really change. That's the what to watch video. That's what's really speaking to us right now. And this will change. What you saw a week ago, if you watched that video, is going to be slightly different than what you see here. There are some charts that are the same, and I typically refer to these as my primary indicators. Then I have a number of secondary indicators that kind of come and go as they're telling us something. This is being prepared for Tuesday, May 28th. The first area that we look at are the positive things. Now, this could easily switch over to the negative side. It's just where are they right now as of Memorial Weekend? Because if we see more downward action like we saw on Thursday, yeah, some of these things could turn negative. And some of these charts that we look at that are positive are not necessarily screaming positive right now. The first thing is a primary indicator that I use, and this is the foundation of what I do. I want to know the condition of the trend. Most folks are trend traders. You want to buy low or sell high. If you go short, you want to sell high and buy low. Well, there's also a period of time when we're really not trending. We're just kind of chopping around. And this helps to determine when we're in that kind of an environment. It's called the average directional movement, or ADX. The main indicator is the black line that you see going through the chart. I put a moving average on top of that just to give it a little bit of context. When we're going above the moving average, that means that the trend is getting stronger. When we're going below it, that means we're generally in a weakening trend. We can also look at the green line and the red line. Whichever one is on top, that's what we default to. Right now, the green line is on top, even though it has been declining. This is a little bit of a concern to us because we were starting to go up with the green line going up, but then we had that really bad day on Thursday, and this indicator really didn't update in a positive way after Friday. So the green line is still coming down. We're seeing the ADX itself starting to drop below the moving average. Now, this could be just an adjustment that's going on within the indicator itself. This blue line is 20, and this indicator was built around static numbers to suggest that when we're below 20, we're in a non-trending environment. When we're trending, there are certain types of strategies to be implemented. When we're not trending, there's other kinds of strategies that can be implemented. Now, I put this at 20. Most people might use 25. I've even seen 30. I have found for the S&P 500 that 20 works fairly well. So I've adjusted that just a little bit. But we are in a positive trend, but it's not really strengthening at this time. We want to see the green line going up, the red line going down, and the ADX turning back up above its moving average. That would suggest that we're in a positive strengthening trend. The next chart I have been showing, and I don't really include this as a primary indicator, but this can give us some clues as to what's happening inside of the S&P. This is a 10-minute intraday chart. And we measure in the blue area large cap growth. And when the blue line is above the red line, and the red line is value, that means that growth is outperforming on an intraday basis. And that's what we want in a more positive environment. You notice when we were really going down in April, the red line, at least for a while there, was above the blue line. Then we shifted over. We finally hit bottom. As we've been coming back up in May, there are periods of time when the red line's on top, but for the most part, I guess not even for the most part, we have been seeing the blue line. So the market can still go up, even if the red line's above the blue line. This just gives us more of an indication of what's going on. And typically, in a positive environment, we want to see the blue line on top and also going up. Another measure is between growth to value for the S&P 500, and we take a ratio with this, and this is also a 10-minute intraday chart. When this is going up, that tends to be more positive. If we want to stay positive in the S&P, we want to see this ratio continue to go up. Then we look at some end of day charts, and I don't deal with the small caps, but I still like to look at them to see what's happening there. And they've been really frustrating in 2024. You look at the line or the bar chart up on top of price, and we've been range bound. We can't seem to break out up here. We get up, come back, get up, come back, get up, come back. And we're kind of in one of those comeback times, at least right now. We look at the ratio down below, growth versus value for the small caps, and it had been languishing a little bit. Well, now it's finally starting to see some improvement, but we want to see more than that if at least the small caps look to be turning more positive. We do that same thing with mid cap growth to value. It's really been lagging behind lately too, but it's trying to make a bit of a push higher. This is the one that I focused on probably the most. It's S&P growth to value and a ratio end of day chart where we are seeing an improvement here, but we want to break out above these previous readings and continue to go up to be more positive. Then we also do another growth to value study here by looking at some ETFs. This is looking more positive. We've been coming up, so showing that growth has been outperforming value. We came down all the way to the 250 period moving average. We bounced up out of that. We hit the top of the rainbow, kind of jiggled around for a little bit, and now we're finally starting to break outside of the rainbow. To stay positive, we want to see this ratio continuing to go up. And discretionary versus staples. We want discretionary to do well in a positive environment. It just hasn't been. It ticked up on Friday. It's still in a longer term uptrend, and I'm focusing on the bottom part of this chart. But we want to see this doing better than it has been. And Tesla's been putting a lot of pressure on this particular sector. We look at some growth to value ratios between indexes. The Qs to the S&P, this is showing some improvement, and the moving average is starting to turn back up. We want the QQQs, which is the NASDAQ 100, to lead. That's what really brought us up out of the lows set back in October of 2022, and also the lows that we saw in October 2023. We want this to continue to go up. But we're a little concerned here because discretionary is underperforming the S&P. We want that to turn and be able to go up. We're seeing a little bit of an improvement here when we compare large cap growth with large cap value. Then another way to look at this is just across the different indexes. We already looked at large cap growth to value. That's looking better. We're coming up above the moving average with the mid caps, but the moving average is still going down. And we're seeing a little bit of an improvement with a bit of a turn up here with the moving average when we look at small cap growth to value. And we're keeping an eye on staples to tech. We want to see which one's doing better. When this ratio is going down, that means staples are underperforming, and staples are more defensive. This is what the market gets into when it's more concerned that we're going to go down. Tech, of course, is the real darling of the market, and I have other charts to show you of the tech sector. This had been seeing some pressure under it where we saw this ratio go all the way up to the 200-day moving average with this ratio. It's been declining. We want to see this ratio continue to decline if we're going to stay more positive. And you can see looking back, coming up out of the COVID plunge where this ratio had been really going down. Then we got into 2022 and this ratio was going up and as the market was going down. Okay, then we keep an eye on the VIX. This measures volatility or fear in the market. When the VIX is very high, that means there's a lot of fear. When the VIX is low, that means there's not much fear in the market. I plot a line chart, which is just the closing value, and then I plot a bar chart, which is the open, high, low, close, and we're seeing very low readings with the VIX. Another indicator attached to the VIX is called the VIX of the VIX, or VVIX, and this had been picking up a little bit, both with the line chart on the bottom and with the bar chart, but we settled back down a little bit in Friday's session with the up day. This is some research that Tom Bowley did, and he's connected to stockcharts.com. He's also had with another site called earningsbeats.com. He has a free email that he sends out every day, and then another one that he shows every month. And I have another bit of his research that I'll show right at the end of the video. This is showing that when the VIX is very low, because there's this old rhyme that says when the VIX is low, it's time to go. Well, not necessarily. You might want to hang around for a while because when we get down to a very low reading, this is when we see the highest annualized returns. So you might want to just camp out there for a bit. Then if we're above 13, but right up to 17, we still see positive annualized returns, but they really drop off. Then if we're under 20, we also see positive annualized returns, but they're about half of what we see when the VIX was lower. When we get above 20 with the VIX, that's when we start to see negative annualized returns. So this is more positive right now with the VIX giving very low readings. It just means there's not a lot of fear, but that can also turn into complacency, that the market is being taken for granted. And it doesn't really like that. Kind of like Thursday, that took a lot of folks off guard when we were really going down. We gapped higher and then spent the day pretty much declining after that. Those surprises can happen when everybody just assumes, yeah, we're going up from here. Well, that doesn't always work out that way. This is related to the VIX, and I've been keeping an eye on this. I showed this a week ago because we were just watching it. We were down below this red area. Well, now we've gone up into this red area. This is called the skew index. When they calculate the VIX, they're using at the money options. Wherever we're at that point, they use those options and then say, what is volatility going to be 30 days from now? This uses out of the money options. And so it's a little different way of doing a calculation. When we get up into this red area, this is suggesting that the market is expecting some kind of a big move, but we don't really know if it's going to be to the upside or the downside. I have some arrows here. Sometimes it was a top, sometimes it was a bottom, sometimes it was a continuation, but we are in this area. Now we can go higher than where we're at right now, but this is the area where we really pay attention to this. And then something happens in the market, and then we finally drop down out of this. Whether that's going to be an up move or a down move is uncertain at this point. We keep an eye on the internals for the market, where the advanced decline line based on price, it ticked up on Friday as well as volume. We really saw it come down on Thursday with that decline. But for right now, it's holding up. And as long as we're above these moving averages, we are looking a little better. Another internal measure are new highs minus new lows. And we're rolling over with our 5 period and actually declining with the 10 period. Now, that's the negative side. The positive side is we're not necessarily seeing an expansion of new lows. We're seeing a contraction of new highs. That's why this moving average is rolling over. So for right now, it's looking positive. We want to see these green lines going back up if we're more positive. We also look at accumulation distribution. This takes volume into account when being calculated. This is considered to be a smart money indicator. When we're above the moving average and going up, that's more positive, and that's what's happening right now. We keep an eye on the advanced decline ratio, both in the short term using 19 periods and then a little bit longer term with 39 periods. We dropped down below zero after Thursday with the blue line. We were able to bounce back up and we're showing some improvement, but we want to see this continue to go up to remain more positive. This is another smart money indicator called the Chaikin money flow. This has been declining recently. It ticked up a little bit on Friday. It was negative as we were going down and showing a lot of improvement. We want to see these green lines continue to go up and the moving average start to turn up if we're to remain positive with this. We keep an eye on the moving averages as they apply just to the S&P 500 index, because there's some other internal moving average studies that I'll show you later. We ticked up with the 20, 50, and 200, but we had been declining, and this was causing some concern. The reason this is positive is because we saw a bit of an improvement in Friday's session. We want to keep an eye on the 20-period simple and exponential moving averages. People ask me all the time, what's better, a simple moving average or an exponential moving average? And my answer is yes. So I plot them both. And a simple moving average over 20 periods, it treats all 20 periods the same. So the first day in the calculation is treated with the same amount of weight as the 20th day. An exponential moving average weights things closer to current prices. And folks think that that's more realistic of what's happening. There's been studies that have gone back and forth. Typically, most folks will use the simple moving average, but we can actually get some insight from this. When the blue line is above the red line, that means the exponential moving average, which moves faster, is above, and that's showing more strength. That's also what we're seeing right now. So that's on the positive side, and we're above both of the moving averages currently. If we have some more pullback, we want to see if one of these lines will end up providing support. And we use that same basic approach with the 50-day moving averages, both the simple and exponential moving average. We're above that. Now, first we keep an eye on the 20s. If we break those, then we start following the 50s. If we break the 50s, then we follow the 100s after that, which we're far away from those at this point. Another way of doing some moving average studies is called the double and triple exponential moving average. And we've been above both of these lines, and the lines have been going up. Well, as we've been chopping sideways and we had the big down day on Thursday, we're rolling over a bit and we're kind of inside between these two lines right now. To turn more positive, we want to get back above both lines and see the lines going up. But it's positive, but we want to see some improvement here as well. We do that same thing with a 50-period double and triple exponential moving average. This has been pretty good. The blue line has actually acted as support. That was around the low that we hit in Thursday's session, and we were able to bounce up from that. This would turn even more positive if we could stay above both of these lines and see the red line, which moves faster, cross above the blue line, but it hasn't done that yet. This is what I call a moving average tree. You could call it spaghetti if you want to. We're above all of the lines that are on this chart, or all the moving averages here. As long as we can stay above that, we're seeing the shorter term moving averages improve and crossing back over above the more intermediate term moving averages. Then we have the McClellan oscillator, and this is actually, it should have been on the negative slide. So just kind of make a mental note of that. We dropped below zero, and this is more short to slightly intermediate term. This is just measuring momentum. We came down below zero, but we did tick up a little bit in Friday's session. To turn more positive, we want to get back above zero. Now, when the McClellan oscillator is below zero, that impacts the next chart, which is the summation index, and we are declining based on price and volume. And yes, these should have been included in the negative section. We're also seeing a little bit more of a negative reading right now with the broader market by looking at the NYSE McClellan oscillator. We're above zero, although we did bounce up on Friday. So we're turning down with the summation index for the NYSE based on price and volume. And the bullish percent index, it's still positive for right now, but it is pulling back. Now, this is a completely different kind of indicator, and this is a primary indicator where it's not moving average based. It's measuring the point and figure buy or sell signals of the stocks inside of the S&P 500. If there's a lot of buy signals, this is going up. If there are sell signals, this is going down. Now, we did turn down, and this did fall after Thursday. We didn't see much of an improvement with Friday's upward bounce. If this continues to fall, that'll be a concern. If we can turn and go back up, that will look more positive. And then when we get above 70, that's when we start to get to an extreme reading, but we're not there yet. The NYSE bullish percent index is also coming down, but still above 50. This is a broader market measure of point and figure buy or sell signals. And we want to keep an eye on the NASDAQ 100 bullish percent index. It's above 50, so it's positive. But even with the up move that we saw, we ticked down with this indicator. A little bit of a concern to us, even though it's still positive. We keep an eye on different advanced decline lines across multiple indexes. This is NYSE common stock, the S&P, the mid caps, and the small caps. As long as we're going up and as long as we're above the moving averages here, we are looking more positive. The oscillators, we're seeing they're still positive for the most part, but the slope oscillator, which is our touchiest oscillator, I have two short-term oscillators, three intermediate-term oscillators, and then two long-term oscillators. The slope, it's looking good, but it's starting to roll back below its moving average. We're rolling over with the other short term called the TSI. We're also rolling over with the MACD, the PMO, and the PPO, but we haven't crossed below the moving averages. The longer term oscillators continue to go up. So we're looking pretty good here. We just want to keep an eye on this touchy one to see if it starts bleeding through to the other oscillators that we follow. The vortex, pretty easy to interpret this. Green line on top, positive. Red line on top, negative. The green line is on top, and it had given us an extreme reading and has been pulling back since then. At some point, if prices go up, we want to see the green line turn and go back up as well. It would be even more helpful if the red line was to continue to decline. And we look at a cumulative advanced decline line for the NYSE. It did go up in Friday's session. Then this is more of a regular NYSE advanced decline line. It ticked up, not huge, but showed a little bit of an improvement. Then this is cumulative measurements on the S&P 500 advanced decline line based on price. And it's really hard to see, but we ticked up both based on price and volume. Then another broad measure, looking at the NYSE common stock based on price, we ticked up. Based on volume, we ticked up. But we want to see follow through with all these advanced decline lines to remain more positive. And we look at Dow theory. Now, traditional Dow theory is Dow and the transports. And the Dow is coming off, even though it's been one of the weaker indexes, it did recently set a new all-time high, but it's been pulling back. What's been discouraging is the transports have just been going sideways at best and even are declining and are really one of the weaker areas of the market on a relative basis right now. Now, I add utilities to traditional Dow theory. Some people don't do that. Utilities have just been going up, and this has been causing us some concern. This is a more defensive area. This is what we saw at the end of 2021. We saw staples and utilities really show some strength, especially on a relative basis. And that was right before we went into the very difficult 2022. So we're keeping an eye on this for right now. It is pulling back. There's some profit taking going on. We'll see. Are we going to continue to fall with utilities, or is it going to turn and keep going higher? Large cap growth. This is looking good. Coming off of just setting recent all-time highs, and we're above all the moving averages. The QQQs, which is the NASDAQ 100, we did see where the shorter-term moving average crossed back above the longer-term moving average and prices above all these lines. That's still looking pretty positive. We did set a new closing high on Friday, but we still have yet to surpass the intraday high. If you can see this, this is Thursday's bar. We opened at the top and then almost closed at the bottom that day. Very negative day. That's when NVIDIA reported after the close on Wednesday. Everybody thought the market's going to the moon. Well, NVIDIA was kind of on a solo trip. It did really well, but the rest of the market had some problems. This is the total U.S. stock ETF, which is 2,651 stocks. We're coming off of setting recent all-time highs. We're above both moving averages, and we're in an uptrend. So this is showing that the broad market is still hanging in there. The FANG index also set another all-time high on a closing basis. This is Facebook, Amazon, Apple, Netflix, Google. I'm sure NVIDIA is in there. This is looking pretty solid, and that's what we want to see. We want to see the Magnificent Seven or the big leadership stocks, the tech stocks, really coming back and showing some improvement, because that's what's been bringing the rest of the market higher. The NASDAQ also set an all-time high after Friday, but not an intraday high. This is still looking pretty good here. And the same thing with the NASDAQ 100. A new all-time high, but still has not surpassed Thursday's high. Mid-caps bouncing up off of its 50-day moving average. This has been one of the stronger areas of the market, especially going back to like the end of January. We were chopping sideways for a while, but then we started to break out. We pulled back with everything else back in April. This has been coming back a little bit, but seeing some weakness. We want to see the mid-caps continue to do well. And then this is another take on Dow theory, where I showed you traditional Dow theory. Well, some people think that might be a bit antiquated. So instead of using the Dow, why don't we use the S&P? And instead of using the S&P, which is a weighted index, why don't we use an equal weight version of the S&P? And that's what we see on top. Instead of using transports, why don't we use tech? We can use the NASDAQ. Well, instead of using the NASDAQ, let's focus on the NASDAQ 100. Well, then let's take that a step further and focus on an equal weight version of the NASDAQ 100, which is the QQQ equal weight. This is actually kind of negative. Yeah, we're looking okay here, but we have set recent all-time highs with the S&P and the NASDAQ 100, but we have not set new all-time highs when we look at this equal weight study. So this is a bit of a negative divergence for right now. We want this to break out. This just suggests that the broader market is also participating in the up move instead of just the bigger stocks. Semiconductors also looking good for right now. This is a huge part of tech, and the fact that they were up really helps the market. Here's the tech sector by itself, also looking pretty positive right now. And then we do some ratios. We look at the QQQs and we compare them with bonds. When this is coming up out of the rainbow like it is now, that's positive. That means the Qs are outperforming 3 to 7 year bonds based on price. We look at the tech sector, also comparing it with bonds. This is showing some improvement. We're up outside of the rainbow for now. This is another ratio. When this is going up like it is now, that means the market is anticipating a soft landing. That means that, yeah, we've been having some economic difficulties. Now, remember, there's the economy as it applies to the stock market, and then there's the real life economy, and there can be a real disconnect between the two. But this just means that they're expecting that after this economic weakness, we're not necessarily going to go into a recession, where a hard landing would mean we are going into a recession. And this is what the market has been anticipating. Now, at some point, this could all change. We can just go with what we see right now, and it's suggesting that things are looking okay. We do a broad market measure with 3 to 7 year bonds. This is above the rainbow. It pulled back on Thursday, but ticked back up on Friday. So the broad market is looking good here. We use another broad market measure, the S&P 1500 with shorter term bonds. This is also above the rainbow currently, so that's positive. We look at the Eurozone. I know this is not an apples to apples comparison because the Eurozone, we compare it with American bonds because Europe sometimes goes hand in hand with what happens in the US. And sometimes Europe is actually leading. If you think of fashion and even to a degree technology, they implemented text messaging years before we even knew what it was in the US. So we want to keep an eye and then compare it with American bonds. And this is still looking pretty solid right now. This is also positive, believe it or not, even though it's going down. This is kind of an inverse by looking at 3 to 7 year bonds versus the S&P. When this ratio is declining, that means the S&P is outperforming. We had ticked back up as the market was running into trouble. Now this ratio is going down. It ticked up after Thursday. We want to see this ratio continue to fall to be more positive. And here's a long-term chart of the NASDAQ 100 going back to 2009. We're above the trend line. So longer term, we're still looking good. Then we look at the NASDAQ 100 to Dow ratio, and I'm not sure what the permanent bears are going to do about this. I actually got the idea a while back for this chart from a perma bear. That means no matter what evidence you throw at them, the market's always just about ready to crash 50, 60, 80%. We came back with this ratio because NASDAQ 100 is growth. The Dow is considered to be more value, even though there's some growth in there. This was the dot-com boom back in 2000, and we topped out, and then after that was the dot-com bust. Then it took many, many years to get back up to this same reading, and this was right at the end of 2021 before we went into 2022, and then we fell back. Well, we're coming back up here, and they're just all excited about this, but now we're breaking above this ratio. We're actually breaking out above these previous readings. I don't know what they're going to do about that. We just follow this. I maintain a neutral stance when it comes to this chart. Right now, it's looking positive because that's what it's telling me. I'm not going to take evidence and just throw it away just so it fits a particular scenario. I like to consider myself a perma realist. So this is going up, which is more positive for the time being. A similar measure is also the QQQs, NASDAQ 100 to IWM, which are the small caps. This had come up to the blue line, fell back. They were getting all excited, the perma bears. Now we're going back up and actually going above this blue line. If we continue to go up, that would be more positive. Another ratio, semiconductors, we came up to this blue line, then we were falling back, and man, they were just excited. Well, now we've come right back up to this blue line again. If we can continue to go up here and set a new high with this ratio, that would mean the semiconductors are outperforming the Dow, and that's a tech part. So we want that to happen if we're more positive. Then we do have some positive seasonality that's coming up for the latter part of May. I have a red box here. This is Tuesday's session, and we follow the green dashed line. This is what happens to the S&P during an election year. And we do have some positive seasonality for that day, and then the green line continues to go up into the end of May. So for this whole week, there is positive seasonality. Now, there's no guarantee. This is just something that we use as a guide. There have been times in 2024 when we've stuck to seasonality really close. There's other times when we've really deviated either above or below what seasonality was suggesting. But we can put this in the back of our mind, knowing that the latter part of May tends to be positive. This is also suggested by another chart put out by Carson. The end of May tends to be positive seasonally, and this is from 1950 to 2023. And this is Tom Bowley, who I talked about earlier with the VIX study. This is what he looks like right here. And he's pointing at you, where we're coming in, according to his research, the latter part of May is when we tend to see more positive returns. The middle part of May tends to be negative. Well, we're out of that now, and we're coming into the part that historically has been more positive. Now we look at some negative things. And yes, there are some things on the positive side that I could have put on the negative side. The fear and greed index. The only reason that I have this on the negative side, because this could change. If we have an up day, we're positive. If we have a down day, we're negative. We saw a pretty big drop on Thursday. We ticked up on Friday, but since overall we've been declining here, I chose to put this on the negative side. But if we go up, we follow that. The only time that we start using this as a contrarian indicator is when we get above 75 to the upside and below 25 to the downside. We ride the wave of that while it's either going up or down. Man, looking at volume, this has been a concern. Since we've been coming up out of the lows, out of April and into May, you see this is a volume oscillator, and it just keeps declining. That is a classical or classic negative divergence. Price is going up, volume is going down. Some people don't take volume into account. I think it's pretty important. Now, price is the ultimate indicator, but the fact that volume has been trailing off is a concern to us. We would really like to see volume go up on an up day and maybe even be down as far as the volume is concerned on a down day. This is a warning sign as well. It's called the Swenlin trading oscillator, developed by Carl Swenlin. He also developed the PMO, the price momentum oscillator, and the studies that go with that. As we were going up here, we started to see the Swenlin trading oscillator going down, and now it's dropped below zeros. So it's negative based on price. It's also dropped below zero based on volume. This is a concern to us. We see a couple of good days to the upside. This could probably change, but for right now, this is a negative sign. And then we're below 50, although we ticked up a little bit. These are stocks in the S&P 500, and where are they in relation to their 20-period moving average? Since we dropped below 50, we're more negative. We want to see this get back above 50. Now, closely related to that is this study, where when we were going down in April, we hit a negative reading. We dropped below 10. And then not too long after that, we saw an upward thrust where we went above 70. Well, about a year ago, a little over a year ago, we saw that same kind of thing. We hit negative 10, we saw an up thrust, and then look at what the market did after that. Now, it doesn't go straight up from here. And even after we had this signal, there were times when we were getting some low readings before it finally started to go up again. But for right now, we're kind of working off this initial thrust. Even though we've been pulling back based on price and not really breaking out with the S&P, we want to see this eventually go back up, get above 70, and then see that confirmed by upward price movement. Stocks above their 50-day moving average. We're just barely below 50. If we can cross back above, that would be more positive. We're still above 50 and ticking back up, but we had been declining with the 100-period moving average. And also well above 50. This is longer term. We dropped down, but we ticked up slightly in Friday's session. So this is positive, but we want to see this going back up to remain even more positive. This is negative, the daily chart. This is a parabolic SAR, and this is also one of the primary indicators. When the dots are underneath, that's positive. Well, we now have dots on top, and that's a concern to us. It came in after Thursday's decline. We need to get above the intraday high from Thursday and break out for the dots to start coming back underneath. And we don't know if that's going to happen or not. So for right now, this is negative on the daily chart. However, on the weekly chart, so a little bit further time frame here, we still have the dots underneath. So longer term or positive, we just need that to see that confirmed in the shorter term. And then here is the new Dow theory. So if you didn't get it before, here's that chart. I guess I did put this on the negative side. Then we look at some ratios. We take 1 to 3 month T-bills, which is pretty much cash, and we compare it with 3 to 7 year bonds. When this is going up, that means folks are concerned about interest rates and inflation. Then we started to drop. Now we're going back up again. We were dropping. And when this goes down, I see that as more positive. But now we're starting to go back up, and that is a concern for the market. We want to see this ratio continue to decline. And we're seeing similar things here with these other studies. 1 to 3 year bonds versus 3 to 7 year bonds. Going back up now, we want to see this drop down below the rainbow. Tips, Treasury inflation protected securities. These adjust for inflation. When folks are concerned about inflation and interest rates, they get into tips. When they're not as concerned, when they want to lock in longer rates, then we see this ratio going down. We were going back up, we're falling back, but we want to see this ratio continue to decline to be more positive. We look at home construction, which is a very sensitive area of the market as far as interest rates are concerned. We were showing some improvement. We poked up out of the rainbow. Now we're falling back into the rainbow. We want to see this go back up to be more positive. And we're looking at the S&P to utilities ratio. Typically, when this is going up, that means the S&P is outperforming, and you can see it pretty much matches up with what happens with price. This has been going down, and this at some point could cause some pressure on the S&P unless we start to turn back up with this ratio. A similar type of thing here, but we want to see this ratio going down. This is staples to S&P. When this is going down, yeah, there's some times when they diverge from each other, but most of the time when this ratio is going down, you can see how the S&P has been going up. We want to see this ratio continue to fall. Staples sector, a defensive area in a longer term uptrend, and has been since the lows that we set back in October 2023. Why is it doing this? If everything's all hunky-dory, folks should be getting into discretionary, but they're still looking pretty strong as far as staples are concerned. Now, on one hand, that's seen as a bearish thing, because when we're setting all-time highs with the S&P and the utilities and staples, which are defensive areas, are hitting highs, that could be a warning sign. There's also been some research that longer term, looking out 6 to 12 months, the market has been up 10 out of the 12 times that they found in the study. Utilities also coming down, but really looking solid here. Another defensive area of the market that we're keeping an eye on. We want to keep an eye on interest rates. This has been going back up, which could cause some problems for stocks. We want to see the 10-year yield coming down. Then we have a thing called the Hindenburg almond. And for years, I kind of disregarded this because it seemed like it was perma bears. See, I'm not a perma bull. I'm not a perma bear. Like I said earlier, I like to be a perma realist. Look at the evidence and then take a positive or negative stance on things. The perma bears are always negative no matter what's happening, no matter what evidence you can throw at them. One thing that they really seem to like is a thing called the Hindenburg almond. Some of you probably remember, the big blimp that blew up in the humanity and all that stuff. And it's also on the cover of a Led Zeppelin album. Well, when we start to see one of these, the perma bears just get really excited. So what we have right here, stockcharts.com has an indicator, because there are 3 parts. In fact, I'm going to go to the next slide. This is all the rigmarole for how to calculate the Hindenburg almond. If you want to pause this and look at that, go for it. What Stock Charts has done is they've taken all the criteria for a Hindenburg almond and they've created an indicator from that. So we don't have to do all that number crunching ourselves. And you can see other times when we spiked up and then we had a confirmation spike and then what the market did after that. This was happening right when we saw the COVID plunge. We also saw this at the end of 2021. The problem that we're seeing right now is that we just see one spike. We have to see another spike within 20 trading days, so roughly a month. If we see another spike, then yeah, that could be rather negative. It's not confirmed right now, but I will be watching this and we'll see how things develop going forward. Here's again the instructions and the explanation of the Hindenburg almond if you're interested in that. The last thing that we look at is just the dollar. When it's going up, that tends to pressure the market. When it's going down, that gives relief to the market because the exchange rate is more favorable with a weaker dollar. So stocks tend to like it when the dollar is going down. Thank you. I really hope you found this helpful. I hope you're having a wonderful Memorial Day weekend. Have a great barbecue. Please remember why we celebrate this day, for all the people that have given the ultimate sacrifice for our country. Have a really, really nice weekend, and I will talk to you in the next video.